There has been a lot of talk lately about billionaires buying farmland and gold being either a brilliant hedge against systemic collapse or paranoid panic buying by people who have too much money and not enough trust in the system. Here is the full story. Because both of those framings miss what is actually happening. When you look at the specific names, the specific volumes, the specific timing, and the specific assets being accumulated, what you see is not paranoia, and it is not just diversification. What you see is a coherent strategy being executed by people with access to the best economic research, the best geopolitical intelligence, and the longest time horizons in the investment world. And when those people move into the same two asset classes simultaneously, farmland and gold, you do not dismiss it as a quirk of the ultra-wealthy. You ask what they are seeing that you are not. I am recording this right now from Chicago, and I want you to comment what day and date you are watching from, because I always love seeing how far these videos travel, and this story connects dots that most people have not connected yet. And real quick, if you value this kind of no-drama breakdown where we follow the smart money instead of the headlines, do me a favor, subscribe, and comment FinTalk OG so the algorithm knows you want more of this. Now here is the claim making the rounds. Billionaires like Bill Gates, Jeff Bezos, and others are buying hundreds of thousands of acres of farmland. Ray Dalio is in gold. Druckenmiller has been in gold. Family offices globally are increasing hard asset allocations, and on the surface it sounds like rich people being weird. But when you slow it down piece by piece, you realize these two asset classes, farmland and gold, are not random choices. They are the two things that share a specific set of characteristics that matter enormously in the kind of economic environment that serious institutional money is modeling right now. That is not the whole story, but it is where the story starts. So I am going to break down three things. First, what farmland and gold actually have in common at the fundamental level, and why those shared characteristics make them attractive simultaneously right now. Second, what the billionaire buying patterns actually show when you look at the data and the timing. And third, what this means for you, because you cannot buy 100,000 acres of Iowa farmland, but you can understand the thesis and find the version of it that works at your scale. So let's start with what we can verify. Bill Gates is now one of the largest private farmland owners in the United States, with holdings across over a dozen states totaling hundreds of thousands of acres. Jeff Bezos, Ted Turner, John Malone, and others have made significant farmland acquisitions over the last several years. These are publicly reported through county deed records, SEC disclosures for the corporate entities involved, and investigative journalism that has tracked the purchases systematically. This is not rumor. This is documented. At the same time, institutional gold holdings have increased significantly. Family offices, which manage wealth for ultra-high net worth individuals and dynasties, have been increasing their gold allocation as a percentage of portfolio. Hedge fund managers with long track records of macro investing, people like Ray Dalio and Stanley Druckenmiller, have been publicly vocal about gold as a core holding. The behavioral pattern is consistent. Real assets, hard assets, things that cannot be printed, that cannot be diluted, that produce something tangible or store value independent of any government's monetary decisions. Now here is what farmland and gold have in common that makes them attractive as a pair. First, neither one can be created by central bank policy. You cannot print farmland. You cannot quantitative ease more gold into existence. In a world where every major central bank has demonstrated a willingness to expand their balance sheet dramatically when economic conditions require it, assets that are immune to dilution become uniquely valuable. Second, both have intrinsic utility independent of financial system function. Farmland grows food. People need food regardless of what the stock market does or what the Fed funds rate is. Gold has industrial uses, monetary history, and cultural value that persist across economic cycles. If the financial system seizes up, farmland keeps producing and gold keeps being gold. Third, both are finite. There is only so much arable land on earth. There is only so much gold that has been mined or can be economically extracted. Finite supply combined with durable demand is the oldest recipe for value preservation that exists. Here is the clean way to think about it. If you are managing $100 billion and you are genuinely concerned about the long-term stability of the dollar, the integrity of sovereign debt markets, and the possibility of a monetary reset over a 10 to 20-year horizon, where do you put money that you absolutely cannot afford to? Lose? Not in treasuries, because the risk you are hedging is sovereign debt instability. Not in equities, because equities are claims on businesses that can fail or get nationalized. Not in cash, because cash is the thing you are most worried about being devalued. You put it in things that will still be there, will still have value, and will still be usable regardless of what governments and central banks do. Farmland and gold. The oldest stores of value on earth. That is not fear. That is logic applied at scale. Here is a question for you. If you had to choose one asset to hold for the next 20 years with no ability to sell it, farmland or gold, which would you choose and why? Drop that in the comments because I read them and I genuinely want to see how people think about this trade-off at different scales. Now let me address the critics because they are not entirely wrong. Could this billionaire farmland buying be partly about tax strategy, estate planning, and agricultural subsidies rather than systemic hedging? Yes, some of it certainly is. Farmland produces income. It qualifies for certain tax treatments. It can be passed to heirs in ways that are advantageous. So attributing all of it to systemic risk hedging oversimplifies the motivation. Here is what you cannot explain away with tax strategy, though. The concentration of purchases. The timing clustering around periods of monetary stress. The geographic diversity suggesting this is not about specific agricultural opportunity, but about broad exposure to productive land as an asset class. And the fact that the same people buying farmland are also increasing gold. If it were purely about tax optimization, you would not see the gold allocation increasing simultaneously. The two together tell a consistent story about how these investors view the next decade, and I am going to say something that might annoy both sides. You do not have to believe in imminent systemic collapse to think that farmland and gold make sense in a portfolio right now. You just have to believe that fiscal deficits are going to keep running, that monetary policy has permanently expanded in scope, that geopolitical fragmentation is creating supply chain vulnerabilities for food and commodities, and that real assets provide diversification that financial assets cannot. Those are not extreme views. Those are mainstream observations that happen to point toward the same allocation conclusion that billionaires are already acting on. A correlation is not a contract. But when the smartest long-term money in the world consistently buys the same two things, asking why is not paranoia, it is due diligence. Now let's map two plausible paths without pretending we can predict the exact candle. Path 1. The macro environment continues to evolve gradually. Deficits stay elevated. Inflation stays stickier than the Fed wants. Geopolitical fragmentation continues. Real assets outperform financial assets over the next decade, but not in a dramatic crash scenario, just steady outperformance. Farmland rents increase with food inflation. Gold grinds higher with monetary debasement. Billionaires who made these allocations 5 years ago look brilliant in retrospect. That is within the set of things this environment is capable of producing. Path 2. Something breaks. A sovereign debt crisis. A currency dislocation. A food supply shock from climate events or geopolitical conflict. In that scenario, farmland is not just an investment. It is operational infrastructure. It grows food when supply chains fail. Gold is not just a store of value. It is the universal exchange medium when fiat currencies lose credibility. The billionaires who made these allocations are not just financially protected. They are operationally insulated from the kind of systemic disruption that financial assets cannot survive. I am not predicting that scenario. I am saying that the people who bought farmland and gold are prepared for it in a way that pure financial asset holders are not. That preparation has a cost, and they have decided the cost is worth paying. Here is what to watch. First, watch farmland prices in major agricultural states. If prices keep rising despite higher interest rates, that tells you the institutional demand is strong enough to override the normal rate sensitivity. That is a signal about conviction. Second, watch the family office survey data that gets published periodically showing asset allocation trends. If hard asset percentages keep increasing in those surveys, that confirms the institutional rotation is ongoing. Third, watch food inflation data. If food prices stay elevated or increase, farmland rental income becomes more attractive and the investment thesis gets stronger. And fourth, watch gold alongside farmland purchases. If the same entities buying land are also adding gold, the systemic hedge thesis is confirmed. If they are buying land but selling gold, it is more tactical than strategic. So what do you actually do with this information at a scale that is not billionaire level? Here is a simple action plan. No drama. Step 1. Understand that the principle scales down even if the specific asset does not. You cannot buy 100,000 acres, but you can buy agricultural REITs, farmland investment platforms that allow fractional ownership, or commodity exposure through ETFs that give you food and agriculture price exposure. The thesis is accessible even if the exact vehicle differs. Step 2. On the gold side, this is simpler. Physical gold, allocated gold ETFs, gold mining stocks. The vehicle depends on your preference for simplicity versus leverage to the thesis. Step 3. Think about your portfolio in terms of what percentage is in assets that can be diluted by government policy versus assets that cannot. Stocks, bonds, and cash can all be affected by monetary policy. Farmland and gold cannot. Decide what percentage of your portfolio should be in the non-dilutable category. Step 4. Do not over-rotate. Real assets can underperform financial assets for years during risk on environments. The thesis is long-term, sizing it so large that you miss a bull market in equities just to be in farmland and gold is its own kind of mistake. Now here are my questions for you. Do you think the billionaire farmland buying is a systemic hedge or a tax strategy or something else entirely? And if you could add one real asset to your portfolio today, farmland exposure or gold, which would you prioritize? Drop your answer below and remember to include what day and date you are watching from. Subscribe and comment FinTalk OG so I know you want to follow up when we dig deeper into the farmland investment infrastructure that regular investors can actually access. And share this with someone who thinks billionaires buying land is just a quirky news story and has not connected it to the broader thesis. All right, keep your head clear and I will talk to you soon. And just so we are crystal clear, this is educational content. It is my take based on publicly discussed information and my own reasoning, and it is not personal financial advice. I am not your advisor. I do not know your goals or your risk tolerance, and I could be wrong. Do your own homework. Consider your situation. And if you need personal advice, get it from a qualified professional who knows your situation.